There was an article on CNBC that was published on Wednesday during the Trump rally that grabbed a lot of attention. Here's How China Could Crush the US Housing Market by Diana Olick pointed out a few really important facts about mortgage-backed securities right now. At the end of January, foreign countries owned roughly $1.32 trillion worth of US mortgage-backed securities, or 15% of the total outstanding, according to Ginnie Mae. Given everything going on with Donald Trump negotiating with other countries in regards to these tariffs, if these countries wanted to dump a very large amount of their MBSs, it would have a very negative impact on the value of these investments. And although this might sound like it has nothing to do with dividend investing, there's one high-yielding sector in particular that could be hit especially hard if these foreign countries wanted to get back at Trump by dumping all of their MBSs. According to the article, mortgage rates are rising sharply this week as investors sell US Treasury bonds at a swift pace. Mortgage rates follow loosely the yield on the 10-year Treasury. Some speculate foreign countries could be dumping US Treasuries in retaliation against President Donald Trump's sweeping tariff plan. But there is another, even bigger concern for both mortgage investors and for the all-important spring housing market. What if China, one of the largest holders of agency mortgage-backed securities, or MBSs, decides to sell those holdings as well in response to US trade policies? And what if other countries decide to follow? At the end of January, foreign countries owned $1.32 trillion worth of US MBSs, or 15% of the total outstanding, according to Ginnie Mae. The top owners are Japan, China, Taiwan, and Canada. China had already begun selling off some US MBSs last year, with the country's holdings at the end of September down 8.7% year over year and down 20% by the start of December. Japan, which had shown gains in its MBSs in September, showed a drop at the start of December. If China and Japan were to accelerate these sales further, and if other nations were to follow, mortgage rates would rise even more than they already are now. So countries that hold US MBSs, if they really wanted to get back at Trump and what he's doing, could potentially dump all or at least a lot of these securities. If that happens, that would cause the value of these MBSs to fall sharply and it would negatively impact the US housing market. There's one high-yielding sector that pays large dividends that would be significantly impacted by the value of US MBSs dropping if what this article details plays out, and that would be mortgage REITs. Many, but not all of these companies buy mortgage-backed securities as their primary strategy to pay their huge dividends. Before we go any further, let's get a good understanding of what MBSs are and how the majority of these mREITs work. An MBS is basically a security that represents a share in a pool of home loans and other real estate debt. Banks and government entities create them and then sell them to companies, which would include mREITs. These mREITs buy MBSs and pay their investors the interest they receive from these securities through dividends. Most mREITs trade near their NAV per share, also known as their book value per share on their balance sheets. If the value of their investments falls sharply, then that could lead to a big decrease in their NAVs, which would cause their share prices to fall pretty significantly. What I just described is how the majority of the companies in this high-yielding sector work. So let's take a look at some examples of companies that are really exposed to these MBSs. AG&C Investment Corporation is one of those companies that's very exposed to this type of investment. According to their website, 98% of their portfolio is made up of these investments. Another company would be Orchid Island Capital. This mREIT holds an overwhelming amount of these mortgage-backed securities according to their most recent financials. Armor Residential is also heavily exposed to these investments. This company has done so badly that they don't even seem to issue their regular investor presentations anymore. Another company is Dynex Capital, which is also about 98% MBSs. So you can see a lot of the well-known big-name players in this sector would be at risk if foreign countries decided to dump their mortgage-backed securities. But there are a few caveats to keep in mind. If you know mREITs, you'll know that they like to hold a specific type of MBS, which are referred to as agency MBSs. Ever since the 2008 financial crisis, agency MBSs have been the asset class of choice for these mREITs. Agency MBSs are pools of residential mortgages that are guaranteed by government-sponsored enterprises, also known as GSEs. These agencies back all of the mortgages inside of these MBSs, so should any of these home mortgages fail, then the agency will buy back the mortgage at its original value. You might be wondering then, if they're backed and fully guaranteed by the government, doesn't that make them and their dividends safe? You might get that impression, but that's unfortunately not how these investments work. Because these mortgages are fully backed, they don't offer appealing returns. The safer the investment, the lower the returns they typically offer. So how do then these agency MBS-filled mREITs offer these substantially high dividend yields? And the answer is they use leverage, and a lot of leverage. Anytime you use any amount of leverage, you're adding risk, but many mREITs use a significant amount to appeal to income investors. Using leverage on such a safe investment class might not seem too risky, but any drawback in value will multiply losses. And with most of these companies, once they experience losses, it's much harder for them to build themselves back up. It's how so many of these companies have seen their NAVs collapse over time. If foreign investors dump their MBSs, then it would cause their values to fall, and it would likely cause this process to speed up faster. But another caveat I'd like to add to this story is, if this does happen, it won't negatively impact all mortgage REITs. Some companies in this sector don't mostly rely on buying MBSs, but have different strategies that help them stand out. Rhythm Capital would be one of those examples. This company relies much more on mortgage servicing rights, or MSRs, compared to MBSs, which are entirely different. They also do something really different in that they own other real estate related companies, like an appraisal company, a property management company, and a title company, among many other company types. There's no other mREIT out there to my knowledge that's this well diversified within the real estate sector. Starwood Property Trust also doesn't rely on residential MBSs. They own physical properties in addition to mortgages, and most of their mortgages aren't in these residential securities. Although they've fallen on harder times, another mREIT with a better strategy is Arbor Realty Trust. This company focuses on the multifamily sector, not agency MBSs. Despite a more challenging environment for them, they have had a winning strategy in this sector, as they had almost non-stop dividend growth for over a decade when times were much better economically. I haven't even touched on all the risks that tariffs are going to cause to this sector, not just countries rebelling. There's the likelihood that tariffs will cause more inflation, which would cause Powell to be less interested in reducing interest rates. All mREITs, regardless of their strategy, perform much better in low interest rate environments. So if rates remain higher for longer, that'll dampen returns on this sector, although again, much more so on these agency-focused mREITs. If you've been watching my channel for a long time, you'll know that I've been critical of these agency MBS-heavy mortgage REITs. In fact, I've been critical of most mREITs with the exceptions I just pointed out earlier. I used to be a shareholder of Annaly Capital roughly 8 years ago, and that was the last time I ever bought into one of these agency-focused mREITs. Pull up a chart of any one of these companies and you'll see that since their inception, that most have lost a substantial amount of their value. Even the mREIT ETFs that exist show long-term losses. You can earn a good return from these stocks at specific times, but almost all of them perform very poorly in the long term. There are so many other appealing investment types that offer high yields. Business development companies, closed-end funds, covered call funds, master limited partnerships, and many individual energy companies to name a few. I haven't bought any additional shares of the 2 better performing mREITs that I own in a while. My advice would be to stay away from these agency-focused mortgage REITs, especially right now, as there's plenty of other great options out there. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher-yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.